I am Terrell Vallery, and we will start the class, and the other students will join in a moment. I am Terrell Vallery on the Prxnce.Tax, and today we will be overviewing standard deductions. We will also review types of income, and we will continue on our tax estimation from the one that we did earlier in the first class. And on this estimation, we will add in itemizations known as a Schedule A, and we will also discuss how to get this person to max using legal tax strategy. There's 6 strategies I'm gonna go over. So thank you again, and do hope all has been well, and happy holidays to everybody. Okay. I'm not gonna start sharing my screen with you all. If you can't see, or if you're not logged into the Google Classroom, we'll discuss that at the end of the class. You go. All right, so to start, comprehensive tax course, chapter 2, standard deductions and exemptions. You go. All right, so the learning objectives. In the first one, I was really doing all the reading. And this one, I'm gonna ask y'all throughout the process if y'all wanna read, and y'all can read, but most of the time I'm really just gonna touch on major points and go from there. But learning objectives for today: standard deductions and exemptions. Calculate the standard deduction and determine when to use it. Define what constitutes an exemption, and then that's a big one for those that have a home. It saves them a lot of money when they do decide to itemize versus standard deduction. But as you can tell, like I stated, married filing jointly is the 63,550 times 2 people. My bad. I'm gonna highlight it a little better. If you work with me. So the 63,350, and then the standard deduction for married filing jointly is 12,700 because the 2 added together, which makes that married filing jointly. So in 2022 and the 2023 tax software, you're gonna see that it says that it is now 26,000 when you look at married filing joint. Okay, and that's what the examples are explaining pretty much. Example number 3, the scenario is the same as example 2 with one change. Lily and her husband now have a son, so they now have a dependent who was born during the year of the tax year. That is important because say you have a child and they're in your stomach, where they're in the stomach of your wife, because the world is very different now. It's crazy. All right, so they're in your wife's stomach, and the baby doesn't come out to next year. So say you have a child and find out you're pregnant, your wife is pregnant in 2022, but the baby don't come out until 2023. You can't put the baby information on your 2022 tax return. You can put the baby information on your 2023 tax return, but not your 2022. But say you find out that your wife or your mate is pregnant, or your girl is pregnant, I have to say girl, or your lady is pregnant, and she has it in 2022, and then she ends up actually having the child in 2022. So then if y'all do decide to file together, or she files or you file, you would be able to claim that child on your 2022 tax because the child came out in 2022. So that's what they meant by born during the tax year. That was important. And Lily and her husband have decided to file separate tax returns. So this is a scenario that you will run into a lot. Most of the time when this happens, as I stated to you, I do not recommend that you do married filing separate as the filing status. Because when you do that, you in turn, you can give them the option if they choose that. I recommend that you would make one of them head of household. That'd be the person that claims the son, and then the other person will be single. And then that way they'll get the best refund, and all parties are happy. Versus if they do choose to do married filing separate, they most likely won't receive a refund. even if they do have the child on there. And if they do use the child and then receive the earned income credit, it's gonna take up somebody's income. You know, somebody refund is gonna go down because they're not using the deduction like they should. And that's just my tax advice. Example 4, the scenario is the same as example 3 with one change. Lily and her husband have divorced during the tax year. Lily now has sole custody of her son. Lily is eligible to file using head of household filing status. She will use the standard deduction. Lily's standard deduction will be $9.50. All right, so in this situation, court has actually separated the two entities. So now one is by herself and the other one is by herself, and the gentleman is by himself. So they're not married at all. This would not be considered marriage filing separately due to the fact that court has separated them and they are divorced. And so now Lily has her own tax return. She has the child, and she had sole custody. So they did not split custody. All that is discussed in the court documents. It is sometimes asked that you advise the tax client that when they have situations of these situations where court had to separate custody, that they maintain their documents because it may be asked by the IRS to prove who has custody of the child. When it comes down to the refund and the credit that is received. Especially when some court orders say that the mother can have the child X amount of years and the father can have the child the other years. There are some decrees like that too. And if that is the case, we would just ask the client to provide the information. We would save it in the tax code. All right. And those are 4 examples. And as I stated earlier, head of household receives a greater deduction than single. All right. And we have the standard deduction for age 65 and older or blonde. And I did mention this last time when I went over the pay stub estimation, that individuals 65 and older receive a greater deduction, a higher standard deduction than individuals who are single or head of household and younger than the age of 65. Also, individuals who are blind or disabled receive a greater deduction than individuals who are not blind and disabled. That's just due to the fact that the government feels, that it's an extra aid for them, and an extra way to alleviate their tax burden. All right. This is a chart fully explaining the information. I recommend that you get the chart by going to Google or any search engine and typing in 2023, and you can get the updated numbers for this chart. All right, these are more examples. All right, who should itemize? This is important. If his total deductions are more than the standard deduction amount, or if he does not qualify, cute little baby, or if he does not qualify for the standard deduction. All right. So what is they stating here is they're individuals. When you ask for their medical bills, you ask for their college, books. Let's see. What's one that's like everybody? Car tags. It's a whole list I'm gonna go through, and y'all gonna actually get to see it in the software. And when you see it, you just ask the client that. You just be like, "Hey, do you got this going on? Do you got this going on?" They're gonna be like, "Yeah, I did have that one time when I went to the ER." And they're gonna be like, "Yeah, it was X amount of miles away from so and so." And then the charitable donations, I gave like $750. They're gonna explain it all to you once you start asking away. And if that amount totals up to more than the standard deduction, then they're going to use the itemized deduction instead of the standard deduction. And because we're doing more on the tax return, that's the reason why it costs more to do that. Because the standard deduction is automatically given to them. That's what the government say, hey, we got you. You know your money ain't just for just sitting in the bank, okay? So we're going to let it say that $12,163 is enough for you to raise your home. That's what they say. That I don't feel that, but that's the reason why people get to itemize and they get to have that negotiation with a tax preparer, like I said. And that's why we're so important. Because without us, as you could tell, the government is like, hey, we told you had this amount of money, so now you got to pay up. All right, so itemized deductions on the Schedule A. That's what the name of the form is on the 1040. So when you're in the tax software and the individual wants to itemize, that means you now need to add the Schedule A to the tax return, okay? And I'm gonna show you how to do that. And as I was stating earlier, Schedule A deductions will be out-of-pocket medical expenses, dental, prescription. And if you have actual receipts, bank statements, proof of these expenses is even better. So unreimbursed employee business expenses is a big one. Say you're working for a company and they state that they want you to leave early so that you can arrive on time, and you had to go book a hotel, lodging, things like that, food expenses, that's unreimbursed employee business expenses. And that's really big for individuals who have to pay tolls or have to pay parking fees when they have to, like nurses. That's one big one from, I have a client that works out of Boeing in California, and they have to pay for parking to go. Even though they work for the business, they have to pay for parking for the parking place, and that is a big reimbursement for them because the employee doesn't pay for that. And other miscellaneous expenses. Miscellaneous is a big word, so it covers many different things. So if the person got a receipt for it and they have proof of it, they can claim it. But you do advise the customer, hey, look, if you keep putting all this down on your Schedule A, you will in turn cause the state to hit you, not just the federal. And when the state hits you, they're a lot more strenuous, and they want more concrete evidence outside of the proof that the client may be able to provide, and they end up getting themselves in trouble. So you just want to be very careful about not overdoing it on the Schedule A, because in turn you'll create an audit too. Make sense? All right, so married persons file separate returns. We're not even worried about them. We're gonna tell them people they need to file single and head a household. That's how that goes. All right, so review question number 1. Oh, we finally got a review question. All right, Maria are both over the age 65. They have one dependent, Maria's mother, who is legally blind and 85 years old. And Leo and Maria will file married filing jointly. What is their standard deduction amount? Okay, I'm not gonna go over the number part. I'm not gonna discuss A, B, C, D. We're not really worried about that. But what I do want to discuss is they have one dependent, and it's Maria's mother. Okay, do y'all see that part? Y'all see it, just kind of like I see some of y'all. So yeah, so that is important. They're not saying that Maria's sister is 85 years old. They're saying that Maria's mother, okay? So that means that if your mom or your parent or someone else lives in your home, they can be claimed as a dependent, but they do not necessarily give you earned income credit. Earned income credit is what you receive for like little babies that are your children, not somebody else's children, unless they're your grandchildren. Get it? But they still link to you. So that's the reason why that person get it. But these individuals would not receive an earned income credit, but they do receive a standard deduction increase due to the fact that they are claiming their mother on the tax file. And it's like an extra $500, okay? So when you have individuals who have like 9 people living in their house, okay? Let them put them 9 people on the tax return, and you explain to them, hey, look, these 9 people with you. So I need you to tell each one of them that depending of you taking care of, depending on your house, they're in your house, they're your 9, okay? They're your 9. We're gonna put all 9 of them on here. Every single one of them gonna give you a deduction, okay? That's how that works. Now, most of them 9 people gonna try to go file their own tax return. So it's very important that when you're talking to the person that actually is like over the home and managing what the actual home got going on, you tell that person, hey, make sure you advise everybody else that you claiming that, hey, you will be claiming them, okay? Because they've been living in your house. And that might happen a lot this year due to the fact of how the earned income credit is no longer as high as it used to be, because in the past 2 years, it's been extremely high. It's been like over an extra 1,600 on. This year, the earned income credit for a child will be about 5,400 for one child. 2 children will be about, I think I have to look at the numbers, but it's like 8,000, something like that for 2 children, and then 3,000. Then 3 kids or more is about the same amount as the 8,000. Not that, it's like the numbers is like when it was in 2019. I'm gonna drop a visual of that in the Google Classroom so everybody can review that. That is important. And a lot of people expecting these big refunds because they've been getting for the past 2 years, but now the tax law has kind of reversed itself, and now we back at this. So there are ways to help those individuals, but they also have to listen to our tax advice and follow it throughout the whole tax year, and not go tax exempt, which is one of them. A lot of people trying to. All right, review question number 2. Don't worry about that one. Here we go. All right, exemptions. Exemptions are an amount that most taxpayers are entitled to deduct from their income before computing taxable liability. All right, exemptions can be claimed for a taxpayer, spouse, or qualifying dependent. All right, so exemptions is what we know better as on the W-4 form when we're filling out with our employer and we telling them, hey, we got this many people that we take care of, like I just was discussing. So my exemptions would have been 9 if I got 9 people in my home. That's 9 individuals that I'm caring for. So I will most likely go tax exempt for the year because I need all my money. You know what I'm saying? So that's that. All right. Identification number requirement. All right. A social security number must be provided for all dependents. So you can't say somebody's your dependent and you don't have their social security number. If a social security number cannot be obtained, an attempt should be made to obtain an I-10 or ATIN. All right, so I-10 number is with individuals who are, all right, so the best way to put it is not that the aliens or that the immigrants, these are individuals who have to apply for a social security number due to the fact that they wasn't given one when they were born here in America. Because like when you're born in America, you receive a social security number. Say you like a foreigner, but not like illegal immigrant or nothing like that, but like a foreigner, then you would obtain an I-10 so that you can receive taxes, but you wouldn't receive like credits such as earned income credit, and I'm gonna discuss that in a few. All right, so if a child was born and died in the same year, a social security number was not obtained, attach a copy of the birth certificate and death certificate. All right. So what this is stating is, all right, say you have an individual, and this is gonna be big in Georgia most likely, because in Georgia, in 2023, the state of Georgia is giving a greater credit for those individuals who had an unborn child. It's important. Like state law is crazy right now. It's and you'll learn about this as you continue to do taxes. Each state is different, but in the state of Georgia, for when you have taxpayers that are coming out of the state of Georgia, your tax refund for the state of Georgia will be huge, especially when they have like an individual where they have a situation where they're claiming a unborn, and in Georgia is due to the first heartbeat, something like that. So they're still working on the actual state law part, but it's based on the first heartbeat in the metro sound, something like that. But whenever the first heartbeat came in Georgia, right, you're receiving your earned income credit. 2022, which was for 2023. So it's really crazy. And then in 2023, they kind of just gonna get better at how they gonna pay that out to individuals. But people out from the state of Georgia will have greater refunds. And this is pretty much how we will help them individuals. Of course, I will have more tax knowledge on that for y'all as we get into the season, but that's definitely something that's big for those individuals that have Georgia addresses and Georgia driver license. That'd be the only way they can get. earned income. All right, so phase out. Personal allowance phase out. All right, so what they're speaking about is when you make this much money as a single individual in 2017, you do not get to pretty much claim earn income credit and things like that. So this is in 2017, okay? So as you can tell, when you make more money as head of household, okay, that's because you get a greater deduction for head of household. So you had to make $20,000 more. This is the phase out people. These are the people that made so much money they ain't even worried about no earned income credit. They just getting they're not even getting refunds. These individuals are really just filing their taxes. And we charge them about $250. These people, when they put it in, is about $250. I got like 10 of these clients. I got that many that's in this area right here. But I got a lot that be right here. I got like 10 right here. And I ain't got this one yet, but I got like 10 of them right here. I got like 10 clients in this area. It's so cool. I'm close. I'm close to this. I'm not there yet. I'm close. So close. All right, so personal exemptions. All right, so both the taxpayer and the spouse qualify for an income exemption, even if one spouse had income. All right, so married filing separate taxpayers, their spouse has no gross income, the taxpayer can claim an exemption for the spouse without their consent. A child cannot claim an exemption for herself because they're being claimed by somebody else. And Form 8332. All right, so this form, this is for the individuals who have children and they already went to court and discussed everything, and now they have to add this form to their tax return because the other custodial parent is saying that they're not claiming the child. Make sense? All right, so that's Form 8332. That's what that is. So it has to be court approved. You should not just be adding this form. And what people do is, let's see. All right, it's something that has to be discussed between both taxpayers. So mother and father, before they can use Form 8332, which I've stated is court order. If they don't have like court order to do it, don't really add it. That person is in a rush to file because they feel like the other person's finna file. And the only way they can stop that from happening is by getting an identity pin, okay? And the identity pin is the number that must be filed on the tax return so that the e-file doesn't process. All right. So if you have an identity pin and it's not on your tax return, the e-file won't go through. The person has to mail in that tax return. Okay. E-file is the process where taxpayer receives their refund in 1 to 3 weeks. 1 to 21 business days. I mean, not 7 to 21 business days. All right. So dependent exemptions. Okay. The taxpayer is allowed one exemption for each person. The taxpayer, all right, the term dependent means qualifying child or relative, okay? So you can claim your uncle, you can claim your little niece, but you can't claim Jimmy Jew, who you knew up the corner. You can't claim him. Can't claim him. You might know him. He might have been at your crib, but you can't put him on your tax return because he ain't a qualifying relative. Make sense? Okay. I'm telling you, taxes is crazy. People try a lot of things, especially when they see these big refunds. All right, so next, the taxpayer can claim an exemption for a qualifying child, a qualifying relative if the following 3 tests are satisfied. This is important. This is in your quiz, unless you're gonna think at the end. And I'm gonna actually move y'all quiz to Wednesday for you all, so that way y'all can study and review the playback of the video. I know a lot of y'all had a lot going on over the weekends. The weekend before Christmas is always busy, always crazy. So I appreciate y'all stepping in. All right, so here we go. And taking the time out. We're gonna get so much money, y'all. I hope y'all telling y'all friends and family. Okay. So the taxpayer can claim an exemption for qualifying child, qualifying relative if they meet these 3 requirements. 1, dependent taxpayer test. And 2 is the joint return test and citizen or resident test. All right, so what is the dependent taxpayer test? Can the taxpayer be claimed as dependent of another? All right, so what that statement is, if you claim somebody, can somebody else claim your dependent? If it's yes, you good. As long as you you pay more of the money for the child, that's why you get it. Now, if it's no, then you can't get it. Okay. Joint return test is the person is the child filing a return as a married or filing joint person. If it's yes, you cannot get it. See, that's what they're saying. And they're saying no, the taxpayer can get it. So if they are a married filing person, then you can't get it. You know, so they cannot be married and the child cannot be claimed by somebody else. Perfect. And then they have to be a U.S. citizen. And the person is a qualifying child or your relative. Or the little baby turning up over there. Dependent taxpayer test. All right, so they pretty much gone over the dependent taxpayer test, and I just was explaining this to you just now. That's a joint return, citizens, residents. This is what I was just speaking about earlier when I was talking about I-10 individuals and individuals that have social security numbers. This is speaking about adopted children. This is all gonna have paperwork. So if a child is adopted, there's paperwork that go with the child. And you ask for that. If they do not have that, you cannot sit there and adopt a child. That's called a lie. And you're gonna receive a $500 penalty. Child's place of residence. This is very important. All right, so where the child lives, the school residency, you want to make sure everything matches up because that's how the IRS verifies information. So if somebody were to claim a child, receive a refund, then they get a letter in the mail saying, hey, you weren't supposed to claim this child. This is what's going on, and you need to prove this now. They would need to turn in school records, immunization records, lease with their children's on the name on there. That information all must line up. And if they don't have that, then they wasn't supposed to claim that child. Make sense? And then the IRS determines if both people have all that information, the person with the higher income is the person. And that's what all this is right here. Test for qualifying child. This is all important because these are the reasons on how the IRS makes sure that you get the credit that you're supposed to deserve. I feel you're supposed to get the max. That's what I'm here for. Get you the max. But relationship test, age test, registry test, support test, and joint return. It was talking about relationship when I was talking about mother and father, whether it's your uncle, your auntie, it could be your niece, it could be your nephew, it could be your grandchild, it could be your granddaughter, grandson. But it cannot be your step cousin, can't be your first cousin, can't be your triple D cousin from down the hood, can't be none of them. Gotta be actually related to you by blood. Gotta have some type of birth certificate that prove y'all got some type of relation. Because I done had some people talk about they was half brothers and half sisters, and there ain't no birth certificate linked to it, you know. And that's explaining what stepchild and half brother and half sister is. Jesus had a half brother. His name was James. That goes to the Bible. So that's what all this is right there. So yeah. So you got Papa was a roller, he be stoning. You got some kinfolk that you don't know, but they're your kinfolk for real. That's your half people. That's your half people. Step people is your people that married in. You feel me? So they got like married paperwork that say your child linked together. That's how that goes. That's where that comes from. All right, and all that's important because all that comes with the family tree. All that's important. Age test. All right, so this is important too. All right, so at the end of the tax year, the child is under the 1098T. It's just that people who are in college normally receive a 1098T, so it's an easier way to prove them when the IRS were to ask for more information. As long as that student receives a transcript from their academic institution, proof that they did learn in this place, then they're considered a student. Okay? Doesn't necessarily be college, just trade, whatever it is, because you got some people that go to cosmetology, all these other places. These are students who may not receive 1098Ts, okay? But as long as they could provide a track transcript, and they can be called a student for somebody who can claim it. That makes sense. All right, so as long as they're under the age of 24, they're 25, they gotta do this themselves. They're not gonna receive EIC credit. At anytime during the year the child is permanently, totally disabled. These individuals can be any age, claimed by anyone that is of relation to them. Okay. You will have individuals who, are permanently totally disabled that care for others. And this is how that works. And that's the reason why they receive a refund for that individual. And that's what it's based on. All right, these are examples. Residency test is the place where the child lives. Okay, taxpayer child must have lived with taxpayer for more than half of the year. Again, this is a residency test for the IRS. This is how they determine if there is a situation where one child lived here 6 months, one child lived here 6 months. The IRS will determine if both taxpayers file a tax return. Say one taxpayer filed early filing season, right around January 2nd, early before everybody. All right, boom. And then the other person came later. They couldn't file, they couldn't e-file, so they had to mail in their tax return. That mail-in return would come later. This person would have got a refund. They then would have to prove that information. And if they didn't prove it, this person would get the refund and this person would have the oath. So that's what ends up happening. Okay. And we went over that. All right, joint return test. That's not that important. Special rule for a qualifying person. And this is what I just was speaking about for people who have qualified for more than one person with more than one child. This is the tiebreaker rule. I just was discussing that. If only one person is the child's parent, the child is the qualifying child of the parent, but say the grandparent claims the child, something like that. It's the person who has the highest AGI. Highest AGI is the gross income for the year. That's who the IRS is going to award it to, because that's the person that provided more of the support. This is explaining that child live with parent and grandparent. These are the examples. Two persons claim the same child. The IRS, as I was stating, would disallow the person with the lower income and give the benefit to the person with the higher income, the person that has more income. All right. Just more examples of how to explain that. All right, divorce or separated parents who live apart. Like I just stated, divorce is a probate, is a court, it's a decree. So yeah, if they have divorce, they got some type of court order that comes with it. Just ask for the paperwork. They'll give you the paperwork happily. A lot of divorce people love showing their divorce papers. They do. But yeah, so they'll definitely show it to you with ease, give you it, upload it, and just keep it pushing. They do not ever use marriage filing separate unless they like link to probate. Probate is people that have land judge going on, and these are people that like own business together. All right, test again for qualifying child, qualifying. All this is important when you're asking the probing questions to your client. These are your new clients that you're bringing on. You don't really know about their lives. That's why you have to ask these probing questions. And a lot of this, you can take it like, hey, this is the truth. This is what it is. But when you ask these probing questions, if they can't answer it, then you got to ask more detailed questions and you need to get that documentation. Because if you don't, you end up putting yourself in a situation where you're going to owe $500 for everything that you didn't report correctly. Make sense? And if you owe $500 out, that's the best way to put it. Won't owe nobody out. All right, review question, blah, blah, not really worry about them too much. We're going to review. Y'all can always review all this inside your Google Classroom. All right, so federal and state and local income taxes paid by persons that from their own income, life insurance premiums. These are more things that somebody can itemize and increase their lower their tax liability, which may in turn increase their refund. All right, Social Security and Medicare taxes paid by a person, funeral expenses, scholarship received, survivors and dependent educational expenses. All right, so this example is kind of cool. All right, so I'm gonna just read it out. Example, Vernon, 17-year-old son Michael's using the personal funds, buys a car for $8,500. He had 11,000 in savings account before he purchased the car. Michael also had a part-time job after school, earned 3,500 total wages, and was able to save 900. Verna and her son live alone. Verna supplies the following support for her son and her household. All right, so Michael is Verna's dependent. Okay. Yeah, quite a bit of savings at 17. He spent it all on a car, but he had quite a bit, and he got it from his part-time job that he earned 3,500 for the year. He only saved 900. That's what he got in his bank account. That's not really that important. So all right, so as you could tell, Michael doesn't really pay any expenses for the house. So Michael would not be claiming himself. So can Verna claim the expenses that she pays for her son? So that is going to be okay. So the education she can claim, she can't claim his clothing, and she can claim his dentist. She can't claim his clothing, okay? She can claim the food as she has her receipts. She can claim the utilities. She she it's a two-sided sword as she claims that rent, because that rent will be too much and it will in turn cause her to get audited. But if she wanted to, she could claim the utilities. She could claim everything that she got a receipt for. Okay. She could put anything that she wants on her Schedule A. But I would honestly recommend she only claim the household repairs and the utilities and the food. She could really claim the food because food is like groceries. Groceries are itemized deduction. Definitely could claim that. The utilities is a two-sided sword. It may jump her over too much. I would tell her go do something rather than donations, just to help y'all out. Now, the things that she paid for her son, she could claim his education expense and she could claim that dentist fee. All the rest of the stuff she cannot claim that she did for us. The beach week, the clothing, none of that stuff she gave her money for, and she claimed. All right. And that just explains that. And I'm gonna go over that in a moment when I actually do a tax return. All right, so filing a tax return for descendants. All right. A final return must be filed if the following requirements were met. A personal representative, administrator, or executor must file the final return, and any returns not filed for preceding year. Word deceased, the descendant's name and date of the death should be written across the top of the return, and someone other than the spouse or personal representative is claiming a refund for a descendant, he should file Form 1310. All right, so what this is saying, that first of all, deep condolences to anybody who had any loss, anything like that. Throughout the year, or just any time in life, always send our prayers up. Deceased. Deceased individuals still did work throughout the year, just like individuals who go to jail, just like yeah. So individuals go to jail, deceased, they worked before either they passed away or they went had got sentenced to jail. You can file a return on their behalf. And the way that would work is, if you are the person, like the actual relative, then you would file it like they're stating here, you're at Form 1310. Now, if you are like their mother or their spouse, then you would just file a return according with 1310, and then you will write the name of the deceased. You write deceased, and then you write deceased name, and then you write the date of death at the top of it. It will also be provided on the tax return because, as you saw, there was a date of birth and there was a date of death when I was filling out the tax client information. Okay? All right, survivors. The survivor may qualify for certain benefits on his own return. Inherited property, joint return, descendant as a dependent. All right, this is just explaining that they may have inherited property. The survivor spouse does not remarry. That's the qualifying widower. Descendant as a dependent. As a descendant was the taxpayer's dependent for part of the year before death, the full exemption amount can be claimed. So say first of all, condolences, prayers up. Say somebody that your child, your person that you take care of passed away mid-year, any type of situation like that, that person would actually be able to go on that deceased individual will be able to place would be on your tax return, and you will receive a full exemption, or the full amount can be claimed for that person. All right. So that is return assembly. Forms are identified by using numbers. As I stated in the last class, schedules are identified by using letters. So they got Schedule A, Schedule B, Schedule C, Schedule D. There's an F. A sequence number is found in the upper right hand of every form. The return should be assembled with form 1040, 1040A, and 1040E first, and then forms and sequence schedule should follow behind. This is back when we had to actually print out the paper and mail it in. This is how you would mail off a tax return. This is also important for individuals who do not have the identity PIN. We've already done the tax return. They pay us up front. Then we mail off we would print out the tax return, give it to them. They would mail it off to the IRS. Not your responsibility. You are the tax preparer, so you just gotta prepare the taxes. All right. But when you are doing this and you have a situation, just simply contact me. I'll help. All right. Return processing. Determine filing method, prepare my signed return, taxpayer must sign return, taxpayers must be given a complete copy. Every tax return we do, we're gonna save the final tax return. We're gonna email a copy to the taxpayer, and then that way we have a copy, taxpayer got a copy. I always do email. I do have some clients that like paper copies. I don't charge them more for a paper copy. If a client does need a paper copy, they can get a paper copy. Just depends on where they're at and where I'm located at. All right, so tax withholding. Must complete Form W-4, and we're almost done, you all, with the very first chapter. Thank you all for your patience. At the end, I'm gonna ask y'all if you have any questions. Give me like 5 or 6 more PowerPoint. I'm gonna ask any questions. All right, so tax withholdings. Must complete Form W-4, employees withholdings, allowance certificate. That's what I was talking about when I was stating Form W-4. This is the actual name of it, employees withholdings, allowance certificate. Okay, what does it actually do? One, it will hold at a single rate or at a lower merit rate. Okay. Just 2, you're allowing the number of withholding allowances for the taxpayer to claim. So remember, I was talking about exemptions. This is what goes on that form. Number 3, if the taxpayer wants an additional amount withheld, that would be the opportunity for if someone say you do somebody tax return when you first put it in, they owe $600. Okay. All right. So that's 600. If you divide it by 52 weeks, it give you like maybe $15 a week, something like that. You do the $15 a week and additional withholdings, that person will not owe next year. That's called tax planning. I do that with clients all the time for free. It's just a better way to build rapport, and it helps them know that I know what I'm talking about. That's everything. As long as you know what you're talking about, you're gonna win. All right, so if a taxpayer is claiming an exemption from withholdings, these are people who claim tax exempt. Okay, they're all right. First of all, there's nothing wrong with you going tax exempt. None at all. None at all. There is something wrong with you going tax exempt for the whole year. Okay. I recommend you go tax exempt the last 3 to 2 months of the year. October, November, December. That's when you really need the extra money for like Christmas, Thanksgiving, and holidays. Okay. Now for the people who go tax exempt August through December, March through December, there really ain't no hope, because you really just killed your tax refund. Well, you killed your extra because you had to pay some of your refund to the government. And that's just how it is. Now we can itemize, we can try things, but some individuals are low income and itemization doesn't affect them. Okay, that's important too. Itemization really is for individuals that have very high income. That's the reason why they want to do a lot of tax planning, because by doing their tax planning, it allows them to know where their receipts are. All right. Balance due returns. These are people who owe. I love them. These are people who gotta file. You gotta get your taxes done. So like I was just saying, when they have a balance due, you adjust your Form W-4 as needed. So say you owe $600 when we first put you in the tax software. After you finish working with us, we get you a refund, of course, because we're not an itemized, do those type of things. But that $600 you still owe. So the tax advice would be for you to change your W-4 withholdings and be for you to add an extra $14 per week, which will get rid of your $600 balance. Boom. All right, so the tax exempt people, there really is no hope for people to go tax exempt. When you go tax exempt, you're really just messing everything up. All right, so don't go tax exempt. All right, withholdings on pensions and annuities. Okay, this is important for people who have retirements and things like that, and stock bonus plans, life insurance accounts, and things like that. You want to pay out the 10% tax when you first pull out the money from your retirement. If you don't, you're gonna, first of all, you receive a penalty if you pull out your retirement account, your IRA account before, unless it's a Roth IRA. You'll learn the difference between these. Really, as you do taxes, or the financial knowledge that come to you. But IRA is one where you pull it out, it's not really gonna ding you. That is okay. IRA, a traditional IRA, that is one that would ding you if you pull it out before the age of 59 and a half. Say you put away $6,000, you got it withdrew, put away, but then some tragedy happens. Unless it was not, if it's not a kid being born, a house tragedy, like your house is on fire, it's like one more casualty that's allowed. If it's not one of them three main categories, then you will receive an extra penalty, okay, for pulling out their retirement account. That's what they're talking about right now. Gambling withholdings, regular gambling withholdings is 25%. All this again you can check up on. Withholdings during unemployment is 10%. Now again, that's only if you choose to pay it. If you don't pay out the withholdings, then it doesn't do anything for you. All right, so estimated tax. All right, these are people who expect to owe at least $1,000 or more. And with that being stated, they would divide the $1,000 by the 4 quarterly amounts, and then they would pay it out. When to pay estimated tax: April 15th, June 15th, September 15th, January 15th. So the next time that somebody really who's on their taxes, knows what they got going on, has a business, got it going in motion, January 15th, we dropping the check. I'm one of them people. January 15th, I gotta pay some money to the government. It's okay though. I don't really claim tax deductions. The reason for that is because when you report a business in red 3 times, you're a hobby. The government doesn't see you as a business anymore. And so, yeah, you're a hobby now. And now they're going to keep auditing you every time that you put this business on your tax. We already told you it's a hobby. You did 3 years of not making no money from it. And that's what a lot of people are going to run into this year coming up, because they've been filing businesses and they don't know that. They don't know that 3 years of filing a business equals ding, automatic audit. You know, so hey, that's the reason why y'all in the tax credit. All right, other types of tax withholdings. FICA. FICA is one of the things that you're gonna see. FICA. FICA is Social Security. Okay. Now, if you're looking at somebody's pay stub and it says FICA instead of Social Security, that's what the number you're looking for. Okay. Because remember, Social Security is the number that the number divided by 0.062 equals the number that we put down for their wages when doing the pay stub estimation. Okay. All right. And all this is what comes out your check automatically. depending on what you got going on. Probably not the disability insurance, but definitely these 4 right here automatically come out no matter what you got going on. So self-employed individuals, we pay our Medicare and Social Security taxes when we file our taxes. Okay. Now we can do estimated tax payments, but if we make more money that year than we did last year, our estimated tax payments are just that, estimated tax payments, and we still owe more money because this is how we file out. And that is, and our taxes are really just our Social Security and Medicare tax. Now, those that do estimated payments don't have so heavy of a burden because they're not receiving an underpayment penalty due to the fact that they waited till, the end of the year to file their taxes. If that makes sense. I'm one of the people that do estimated payments. All right, last review question. Yay. All right, so that's PowerPoint number 1. Good job.